But Ajay Srivastava, CEO at Dimensions Consulting as well, joins us on the show. Ajay, how does it feel after that blockbuster for Friday session that we've had? And were you taken by surprise at all?
Well, yes, if you ask surprise, yes, certainly we were taken by surprise. And if you think how I'm feeling very euphoric. At one side of the portfolio looks to be extremely good and doing extremely well. And the other side of the strategy, of course, looks like a sheer roadkill. The PSU shorts looks like a roadkill today. We'll see the time has come. But the other part, which is the main line, the Reliance and the Reliance Infra and the Mahindras and all, those are doing a sterling performance. So it's a balanced feeling, but yes, surprise was there. And I think we should see this continuing for the next 4-5 days at least.
Ajay, for the moment, all kind of rumors, all kind of permutation and combination are flying around on what the formation of the new government could be. Markets currently believe that we will get a NDA government and we will not get a fractured mandate. What happens if markets don't get their way? First on 13th and then on 16th?
Well, we all know that, Nikunj, that is a fractured mandate. We're going to see a sell-off of a magnitude which could be anywhere. I don't think so. It's not going to be a small sell-off. It could even be a circuit breaker kind of sell-off, because not the people who are in the position in the market. The shorts will come in. The shorts have been squeezed out completely as we sit today, which means that all the shorts are sitting with the ammunition dry and saying, okay, let the market come up and we'll come back to the market. Fractured mandate means the shorts enter the fray in a big way. I don't think there'll be maybe too much of FI selling perhaps, maybe some bit and all, but I think the shorts will make the difference between the optimism of the mood today and compared to the reality of a situation that the fractured mandate means uncertainty in the economy, which may not be necessarily true, I would say that, but perhaps that's the reasoning the market will take on that day itself.
Ajay, if I crudely divide the current scenario, I guess there are two propellers. Number one is bank, and the second is the cement sector. For those who are betting on recovery, maybe they are buying into banks. For those who are betting on demand, they are buying into cement. So what is a better strategy? Focus on recovery or focus on demand?
I think the better strategy, if you ask me, is to classify not in terms of sector but in terms of names, because I think, in the banking sector per se is fluid with people whose performances perhaps would be less than favorable if you look at the real numbers, leave us from the stock market and so on and so forth. I would say that the better strategy in this environment is to bet on the names rather than betting on the sectors, i.e. like you already seen the run-up in Ambuja. Now, Ambuja has become an expensive stock, so if you want to bet on cement recovery, and I think generally the theme is that if you are investing today, I think you are now chasing the rally. And that's the most dangerous part of the game you're playing with. I think if you're not invested in the market, in the cyclical sector like banks, cement, etc., stay put right now. Don't rush in to buy these stocks at these prices. They have become expensive. The first cream is off the table. You may be left handing the last tail of the dragon at the end of the day. So I would not say that, both the sectors look expensive from today's perspective, definitely look overbought in the current scenario. And if you want to chase the rally in the stronger names, where even if something happens to this market, you have a chance to recover your money. So mainline stocks is the way to go rather than chasing sectors, because this is an overbought situation we are seeing, and you are chasing a rally which, ends up in a pretty disastrous situation for most investors.
The rally started with PSU banks that went to PSU energy stocks, and now names like BML, BEL, everything is participating.
There is a reason for that, Nikunj. If you look at it, the right way to invest, and we have been invested in this for a long time now, is there's a couple of mutual funds which are very good portfolios. So if you don't want to be specific on a PSU, you want to be betting on them. And there are three reasons for that. One reason I think perhaps is that they were undervalued to a large extent, underinvested, undervalued. The number two is that the philosophy of everybody by and large now is that these PSUs either will be divested or significant stake will be offered to the public or to the investor at the end of the day, and they'll be made to perform more closer to the market. You already seen re-rating of Coal India, for instance. It was running around, say, 200, 240, and all is already running at 310 or 305 or thereabouts. Similarly, BEML was languishing as a equipment supplier. Perhaps it will see revival. But you got to be careful. Again, I'm saying be careful because fundamentals are way behind. So you got to pick and choose the PSUs. You want to pick up Coal India?